Hey everybody, welcome to my first real YouTube video. So I've been doing the Artificially Intelligent podcast for, going on 3 years, actually over 3 years now, where we always talk about AI and economics. And I thought, you know what, let's try to get a video out there, just talk a little bit about what's going on out in the world, especially more on the economic side and a little less on the AI side, at least for today. That'll be the plan. So, yeah, it's 2020, and this has been a crazy year. There's been a lot that's gone on. We've got the COVID crisis and everything that's happening, and we've had massive recession, lockdowns, riots in the U.S., plus it's an election year. It's just been hard to get a lot of stuff done and be productive because there's so much in the world that's interesting that's going on. And one of the things I wanted to focus on is a little bit about investment and the economy. So I had done a podcast back when the crash hit, and it was actually really well received, and there was a lot of good stuff that was in there, and everything's still going well, at least as far as on the investment side. But I've really been rethinking a lot of my fundamental assumptions about investing lately. So I had written this article last year that I'm showing about the death of value investing. And you can find it on Medium and elsewhere if you just search it and look for my name. And it was, a little tongue-in-cheek, but also primarily arguing that value investing is going to return and really do well following the next crisis and the next crash. And of course, as everybody knows, in early 2020, we had the big market crash and everything, and the market's been going straight up. And you've seen even guys like Warren Buffett completely capitulate on a lot of their fundamental theses. So Warren, for example, had never owned gold. He had always talked about how terrible gold was because it doesn't produce a yield. And now news comes out within the past week that he's taken a large position in gold miners and mining stocks, which is a leverage play basically on gold and how that works. But what I was putting out here is that, value investing, sure, it hasn't performed as well as just the passive S&P 500 in the past decade. But I don't think that's going to continue. I think it's going to be coming back. Now, I'm not so sure. I'm somebody who's kind of been raised in the value investing area since I was 20 years old and started reading like crazy about Buffett and reading all Ben Graham's books, The Intelligent Investor and Securities and Analysis, and just everything in that orbit, because it was just one of the things that really interested me and I thought made a ton of sense. And now you have the world's greatest investor kind of changing his mind on a number of things, being Buffett, that is. And yeah, I think I'm starting to move more towards quantitative methods myself, and I'm actually planning to put a series of videos out there about how a lot of this stuff works. And I've been developing a lot of these over the past couple of years, actually, as I've just been getting more into quant strategies and seeing how they could maybe complement or supplement some value investing approaches. But I want to lay out here why I'm changing my mind. So, first off, value funds haven't performed well since January of 2009 versus the S&P 500. And what I'm showing here on this chart is basically how Berkshire Hathaway and a number of value ETFs have drastically outperformed or underperformed the S&P 500. And so, even Buffett hasn't been up there. And, if you think I'm cherry picking data by starting, near the bottom of the last market crash, if you run this for multiple different holding periods, moving your start date and end date all around, you wind up coming up with the same sort of results where, at least 50% of the time you're better off holding the S&P 500 rather than any of these stocks. And now, Berkshire Hathaway is 40-some% Apple, so it's starting to represent the S&P 500 a little bit more and more these days. So it just hasn't performed well. And to understand why, I think we need to take a high-level overview of a couple of things. First, look at the business cycle, and then look at the money supply and how these things are related and how these things affect investing. So I'm going to get into those and just kind of start with the business cycle here. So the basic thing with the business cycle is that you go through these phases of expansion, contraction. You have a peak, you have a trough, and then you re-expand. And this is something that happens to economies all over and is really driven primarily by credit. Ray Dalio actually has a really good video on this, on the credit cycle and how it affects the economy. It's about 30 minutes in length, and if you want to get a little bit more detail, check that out. If you want more on some of the theoretical underpinnings of this, we've always got stuff at Mises.org, and I can always do some additional videos and other things kind of explain some of the details. But typically, you have this expansion is driven by credit, by easy credit. When credit flows out into the economy, you have a lot of people making investments. They go out and they buy a bunch of things. They try to set up an auto manufacturer, or they build a new factory or startup or whatever it is, and put a bunch of money into it, and everything's expanding. But what winds up happening, especially if you have artificial interest rates like we have in the U.S., primarily influenced by the Federal Reserve, you wind up getting malinvestment that takes over. And this malinvestment is eventually going to reach a point where these things are revealed to be unsustainable, that they were never really good investments to begin with. The market doesn't really demand them. Consumers doesn't really want them, at least for the price that all of their resources and inputs are required for in order to be profitable. And so that's where you wind up getting that contraction, and everything fades. And then you get that big reset in the trough. And this is where things clear out, where you have price discovery is allowed to occur again, economy-wide. A lot of that credit is taken away, and then you can start a new healthy expansion again. Now, this is typically how it's supposed to work. The thing is, interest rates are the big mover in this area. And we've been in this 30-year bull market in bonds where interest rates have just been on a steady decline. You've got some spikes upwards as it oscillates, but by and large, the trend has been in one direction, and that's downward. So here I'm showing the 10-year U.S. Treasury yield, which is the benchmark rate for a lot of investors, especially if you come from a value investing background. You use something like this. Consider the risk-free rate for your discounted cash flow. So you've got your 10-year Treasury yield. If it's at 10% and you're discounting over the next 10 years for an investment horizon, that's going to look much less attractive versus, say, a 2% risk-free rate or baseline rate that you're going to be comparing that to. So if you have a 2% yield for your cost of capital, or for your opportunity cost in this case, you're going to be like, yeah, that investment looks a lot better, because those future cash flows are going to be worth a lot more when you calculate the net present value of that. So yeah, it's just been going in one direction for yields and moving down for quite a while, and we don't know how long this can continue. One of the crazy things that you're seeing right now is in Europe, you have negative yielding bonds. Not only negative yielding sovereign bonds, such as like in Germany, Switzerland, or Austria, etc., but you also have negative yielding corporate junk bonds, which is just mind-blowing. And this is something that economists thought for a long time could never happen, because what that means is that you are lending, say, Germany money. You're giving them $1,000 or €1,000 today, and in 10 years, they're going to give you 980 euro back. Who is ever going to make that deal? Well, a lot of people are making this deal because they're betting that rates are going to get lower, because there's an inverse relationship between bond prices and yield. So as the yield goes down, the bond price gets higher. And so if you buy it at negative 1% and you're speculating that's going to go to negative 1.5 or negative 2%, then okay, sure, that there's some rationale behind that. But if you're looking to buy and hold, it doesn't make any sense. But a lot of banks are forced to, through regulation, through Basel III regulations and other things, to actually hold these bonds on their balance sheet. And so they have to buy this as part of their capital base to pass stress tests from the ECB and other regulation agencies. So they actually wind up having to buy this stuff, which has really hollowed out the banking sector in Europe over the past 4 or 5 years, since we've started to see these negative rates, because they're not getting any yield or return on a lot of their stuff. which is just crazy. So you can imagine how that's going to really distort the lending markets and how investors are going to be making all of their calculations when interest rates are pushed down to these types of low levels. So in the U.S., the Federal Reserve is the primary driver for interest rates. So here I'm showing the federal funds rate, which is an overnight lending rate, and the 10-year treasuries. Now, the Fed funds rate isn't the only tool the Federal Reserve has for controlling interest rates. You do see here that they do move together pretty closely, but they've also got the Federal Open Market Committee. They've got their quantitative easing programs. They have forward guidance and Fed funds rate and a few other things in their quote unquote toolbox in order to try to set and control interest rates. And so the idea is that they are going to push rates down in depressions in order to get the economy to expand and raise rates to prevent the economy from overheating. This is all based on a lot of, I think, flawed economic theory. But that's typically how they run and how they try to control things and control the business cycle, those booms and those busts. And this plays out in the stock market a lot, and you can actually see it play out in the real economy as well, because you wind up getting these kind of these phases as it goes through, where you get this credit expansion that leads to that artificial growth and that malinvestment, and then eventually those are going to be revealed as being poor investment decisions and lead to that bust. A really interesting way to actually see this is through what's known as the skyscraper curse, or skyscraper index, or however you want to call it, which is something that's been developed quite a bit by Mark Thornton, who has a really good book. I'll put it in the show notes down below if you guys want to check this out. But he talks about how the skyscraper, world record setting skyscrapers wind up opening by and large in depressions. And it has a lot to do with these interest rates. Now, he's not saying that skyscrapers cause depressions and recessions, as some critics have completely misinterpreted, but that these are correlated and that depressions and recessions have the same sort of underlying cause as a lot of these skyscraper world record breaking skyscrapers. I can't get that out of my mouth. World record breaking skyscrapers. So what we're showing here is a graph from The Economist showing just basically how this has correlated over time. And the reason is primarily threefold. So I talked a little bit about net present value and how long-term projects look to be much more attractive with interest rates are a lot lower, so the cost of capital is a lot less. So when you're building a new skyscraper or any sort of building, typically real estate tends to be on a longer horizon. You're talking 20, 30, 40 years, a long-term project, because not only does it take time to build the stuff, but to buy the land, to recoup your rents, etc. It can be expensive, and these are long-term projects. A brand new skyscraper might take you 10 years to build, depending on where it is and how high it is, etc. These can be very time-intensive as well. So lower interest rates make that a lot more attractive, just from an investment perspective. The other thing that they do is they make land more expensive for a lot of the same reasons. That discounted cash flow or that net present value of the land makes it look much more attractive, pushes up the price of it within a lower interest rate environment versus a higher interest rate environment. And so when you have more expensive land prices, what you have to do is you have to use your land more intensely. And that typically means taller buildings, larger capacity, because you need to offset that cost of the land with more office space or what have you. So yeah, that winds up getting pushed up, and typically, where the land prices are highest are in financial districts for major cities like Chicago or New York, where the land is already at a premium, but then it gets higher. And so if you want to put something new there, you're going to have to build it taller and taller. So that's one effect. Another is that with the lower interest rates, you wind up having more mergers and acquisitions that occur. So this is due to the cost of financing and cost of capital. You have companies that come together. That will buy, a company is going to buy another one out, and they'll be able to have a bigger company. And this typically means that those larger companies need more office space as they co-locate, as they find synergies and shuffle things around. And so they'll expand their headquarters. Oftentimes, again, these are in large cities. And so demand for commercial real estate winds up increasing. And again, this is going to make bigger buildings look much more attractive. And I think if you go back over the past few years, we've had records set in merger and acquisition activity that's occurred over the past couple of years, precisely because of this. So what you wind up having are these different effects that come in. The buildings look more attractive from an NPV and just investment perspective. The land prices are higher, so you have to use the land more intensely in order to to recoup your investment. And you have bigger companies that increases the demand for commercial real estate. And there are some other effects that he lays out in his book if you want to check that out. But those are three of the big drivers that wind up actually pushing for taller and taller buildings. And so you wind up getting a lot of record setters, and they'll typically begin construction during the boom and then open during a financial crisis of some sort or a depression. And so again, you can see how this has happened over the past 100 years, time and time again, with record-setting buildings. So if you're a value investor, typically you pick up a lot of that value at the trough of the business cycle, because that's when valuations are the lowest, when you can come in and buy companies on the cheap, because it's the end of a crash, and you can do great with that. The trouble is that because of the way that these interest rates have been manipulated, is that you aren't getting that kind of clearance that's occurring anymore at the trough. So, for example, just look at what happened in 2020. I was surprised that this was going to occur, that as soon as the crash came in, the Fed stepped in and was able to actually reinflate it. I didn't think that they were actually going to be successful with this, because some of the first initial attempts of pumping money into the economy just to get the market up again were unsuccessful, and you would still get these huge drawdowns the day after, like the Monday after these big announcements by Jay Powell and the Federal Reserve. And so I was thinking, okay, well, here we go. It's setting in. Fundamentals are going to matter again. And I think I was proven wrong, because it did happen for a little while, but it lasted maybe a week. And nothing really cleared out like it should have. Like all this bad investment and other things, where you have these zombie companies and these unicorns and other things. These companies have no returns, no real revenues to speak of, aren't profitable, and are getting these massive billion-dollar valuations. It's just insane, all the stuff that's happening. And a lot of that's because of that, not letting the market clearing prices take hold, just pumping money into the system again and again. And that happens through that interest rate environment and through the changes in the malinvestment, because every time a bank lends, or the Federal Reserve creates new reserves for banks to increase their lending capacity, that winds up creating new money and pushing that into the system. So the next thing I want to turn to is to the money supply. And so what I'm showing here is the U.S. money stock, shown by the M3, which is a broad-based money stock. This, again, comes from the Federal Reserve. And what you see is this kind of exponential increase in the dollars that are in the economy, as according to this measurement. And what you get at the end here, on the far right, that's basically vertical, is this $2.2 trillion increase from the CARES Act in response to coronavirus that occurred earlier this year, where it was about an 18% jump in the money supply. Crazy amount. All designed to try to prop up the stock market at the end of the day. And again, this does a lot to remove that kind of price discovery that we hope to have as value investors, and why I think it's going to be harder and harder, if not impossible, to be a successful value investor in this kind of manipulated environment. So what I want to show here is a plot where on the left axis we have the money supply normalized by the GDP, and on the right axis we have the S&P 500. So on the left, what you wind up seeing is this inverse correlation between the money supply and the stock market. So this makes sense. If you have a fairly stable money supply, or at least one that's increasing less than GDP, you wind up seeing a decline in this red line here on the graph. And at the same time, you see an increase in the S&P 500. That makes a lot of sense, because if you're getting an increase in GDP, you anticipate, at the very least, to get some sort of rise in economic output. And so with a stable money supply, you get a decrease there and your stock market goes up. Makes sense. You can rationalize that. What winds up happening is, following the 2008 crisis, this changes from an inverse correlation to a positive correlation, as you can see on this graph, where suddenly these things start to rise together instead of being opposed. So you get this kind of phase transition, this shift from a new regime of inverse to positive correlation. And so the more and more money that winds up going into the system, the more and more, or the higher prices we wind up getting in the S&P 500. So all the money printing and everything that's been happening from the Federal Reserve to keep interest rates down, to encourage lending, to try to get more liquidity into the system, has basically boosted asset prices and not been used in the broader economy. And so they try to do a lot of this intentionally, and they call it the wealth effect. So that basically they get people to go spend more if they feel wealthier. And so if people's portfolios increase in value, the theory goes, they spend more because they feel wealthier. And that helps everybody out. And this is all kind of based on these Keynesian consumption-based I think fallacies, really, but it's shown that it really hasn't worked. It's really gone to support the stock market and support stock prices, but hasn't helped a lot of people. And that's why since 2008 crisis, you've had a lot of reports of saying this is the weakest recovery on record. With people saying that doesn't feel like a real recovery because you've had very, very low GDP growth, because it's basically all gone to the market. All this money that's out there, wealth effect hasn't worked, and you're seeing that in the market, and you're seeing that here, where your year-over-year GDP growth is actually on a steady decline. So what I'm showing here is GDP growth versus debt as a percentage of GDP. And so as the debt is going up and to the right as a percentage of GDP, the GDP growth tends to be going downwards. So we're getting less and less growth for every new dollar that's created, and that goes out there. And so there's been a lot of academic research and studying on this kind of stuff. And what they find is that typically, depending on the study you look at, above 80, 90% debt to GDP, you wind up getting into that area of diminishing returns very, very quickly. And that's where you need more and more money of debt to be taken out in order to get a dollar of GDP. So if it was 1-to-1 at a lower level, now it's 2-to-1, 3-to-1, 4-to-1, 5-to-1. And so you wind up having this huge burden that winds up being placed on the economy and future generations that isn't really going to pay for itself ever. And so there's really no way to get out of this apart from severe austerity, where the government is going to really slash its spending and borrowing. And I don't see that happening anytime soon. I don't have the chart here, but the borrowing for the U.S. government has just been increasing, again, on this type of exponential curve since the Bush years, basically. And so I just don't see that happening. Politically, it's not going to be feasible. You get inflation, where you can try to inflate it away through money printing, and I think that's what they're going to be trying to do. Put more and more money out into the world to devalue the dollar and devalue the debt as a result, and keep interest rates low, so that the new debt that comes on is going to be more manageable. But this becomes a larger and larger part of the federal budget. And again, as long as that correlation stays where the stock market increases, they're going to be quite happy with that. Although the purchasing power of the dollar is going to be destroyed as a result. And the other way is just basically to default completely on the debt. And the U.S. has done this twice in the past 100 years with the big devaluation against gold that FDR did where he devalued it by, I think, what was it, 66% or so, going from $20, 2067 to $33 an ounce or so, and confiscating gold. And that was one big devaluation because it's now everything that was denominated in dollars. It just took a huge haircut as a result, and they're looking to do the same sort of thing now. The other time was in 1971 when there was another de facto default where the U.S. closed, or Richard Nixon closed the gold window and basically bringing an end to Bretton Woods. In his words, temporarily suspended gold redemption. And so that was essentially saying, hey, all the debt that was previously backed by gold is no longer backed by gold by the U.S. So you're not going to get what we had promised you, but we're now going to just give you these green pieces of paper as a result, rather than the actual physical metal. So there were two defaults. I don't know if that's going to happen at the same level, but I think I'm quite confident that the printing is going to continue unabated, which is just going to be pushing more money into the stock market as we see increasing asset prices and decreasing the value of the currency that you wind up holding, or the dollars that's denominated in. And this does have effects. It has a lot of side effects. One being massive wealth inequality that winds up occurring, because if you're trying to push the wealth effect, who owns most of these assets? They're the people who are definitely in the top, fourth, fifth quintile of wealth that in the country. They're the ones who are invested in these major companies that wind up getting this money first, that wind up getting better refinancing rates for bonds, and are able to grow and take advantage of the cheap debt that's out there, and the increase in stock prices. Whereas the people who can't afford it, it becomes farther and farther out of reach to get on that, and their dollar decreases in value. So they wind up getting hit in a number of different ways, where it winds up benefiting the people at the top. So all of this to say that I'm really skeptical about going forward with the tried and true value investing approaches, because I just think that we're in a regime that doesn't that is so politically manipulated, that I don't see how you're going to be able to navigate that through traditional methods. So, like I said, I've been working on trying to develop some quantitative-based methods, going through a lot of quant trading books, workshops, articles, other things, building my own systems, etc. And I'm planning to actually put together a series of videos, articles, and other things to explain how to apply this kind of stuff. I've been doing this for a couple of years now, because I just don't see how the traditional value is going to be able to hold, as terrible as that is, because I think that's what really makes sense, right? I mean, if a company is able to be able to organize the factors of production, invest in building factories and training its workforce, etc., and sell, make good revenues and do it at a profit, that ought to be rewarded. I mean, that's what it's all about for if you have a business. And the more efficiently you can do that, the more value you have. And if the market isn't necessarily respecting that at the time, and so you have a PE ratio or a book to value ratio or whatever your traditional metrics are that you're looking at that are a little bit out of whack, as tends to happen in these cycles, then great, go put your money in that company, and they're eventually going to be rewarded. Buffett's old adage that in the short run the market is a voting machine. In the long run, it's a weighing machine. So you get popularity that drives it in the short run, but in the long run, you actually see those companies that are valuable. And I'm just not sure if that's going to hold anymore. Just again, seeing that the market has never been given a chance to really reset since 2000, since it hit the bottom in March of 2009. It's just been one way, and that's going up. Just a solid trajectory. And everything else we're seeing, debt, the money printing, and all these other metrics, and we can go through a lot more. I just want to try to pull out some of the most salient ones. It looks like again and again, that's just the direction we're going to be heading. So if you guys are interested, I can get into some more of this in the future, show some more slides, graphs, and then also, like I said, I want to try to teach a lot more about these quantitative methods to try to apply those rather than just this kind of discretionary trading that all the Robin Hooders are up to, or as an alternative and complement to some of the value methods that are out there. So anyway, if you guys enjoy it, like and subscribe, and I'll be back soon.